Hello and welcome to my YouTube channel. My name is Moses. Today we are going to discuss another topic, a very important topic about how to set your stop loss. In the market we are having what we look for is how to make profit, and most of the time we get ourselves confused because we don't know which area we are going to put a stop loss or which is a favorable area and how to set our stop loss. So today I'm going to discuss that, and we are going to know and to learn how possible it is and the ways we can use to make sure that we are not being stopped out in the market. And with that we are going to discuss ways that you can avoid to be caught up in the market in the long side. This one has a lot of things that we are going to discuss that are most important, and you have to be very well advanced and conversant with all the methods, so that depending on the market conditions you are able to be flexible to choose on which area you can put your stop loss. So without delay, let's continue. So before you set your stop loss, you have to know your risk tolerance. This risk tolerance is how much are you willing to lose. So assuming you have an account of $1,000, this tolerance is how much in this $1,000 are you willing to risk per your trade. So maybe what you are willing to lose is allowed $100, $50. Then the position you are going to put your stop loss should accommodate that $50 or $100 that you are willing to lose in that. So risk tolerance is how much comfortable are you willing to risk in that trade. And remember, this is subjective. If you have an 100 account, you cannot risk $100 account, all of it. If you have a $50 account, you cannot risk a $50 account. This will be subjective depending on the amount you have in your account. The next thing is the market structure. As we know that the market moves in phases. We have 3 phases. We have uptrend. An uptrend is the market creating higher highs and higher lows. We have the downtrend, the market creating lower lows and lower highs. And we have a ranging market where the market moves in sideways. So you have to look on the structures. Remember that when the market is moving upward, it breaks structures, break of structures, and then we form the pullbacks. So they are the areas that you need to know. Where do I put my stop loss? This will be characterized by the structure of the market. So the positioning of your stop loss should be guided by the structure you are trading. If you have seen the market has broken a high, you know that your stop loss should be below this low, because if the market violates this low, it means now it is likely to change direction to the downtrend. Likewise, if you are trading in a downtrend, the market is breaking lows, so meaning this high is strong, and if the market violates this high, it means now it is not ready to continue down again, it is likely to reverse. So this area is where you should put your stop loss depending on the market structure that you are trading. In a sideways market, this is a bit tricky because the market can break on any side, so we don't recommend people to trade, especially beginners, to trade the sideways market. What we recommend is find a trading market, either an uptrend or a downtrend. The other thing you should combine is the strategy alignment. Strategy alignment is you are using different strategies. And those strategies that you are using are, maybe there are some people who use support and resistance, others use trend lines, others use Fibonacci moving averages, and there are those, and majority of us, who are using the smart money concept, the supply and demand and what have you. So if at all you have identified a break of structure to the upside, you have to start combining what is available to give you a confidence that the market is likely to go in your direction as you are predicting. So first of all, we have those who look for order blocks, others look for fair value gaps. So if you have identified a break of structure, a BOS, and you have seen there is a fair value gap, so you can use that one. Also, you can look for an order block where the price has originated, and this will guide you on how you're gonna put your stop loss below this low with conferences that are aligning with your setup. So don't get into a trade with just one confirmation. Find other conferences that would support your trade, and then that will dictate a best area for you to put your stop loss. So others, we recommend that you can also use the Fibonacci tool. And the Fibonacci tool, you draw the Fibonacci tool from the low to the high that constituted the break of structure. So this is the BOS, so you draw your Fibonacci from this point to this one. Then the Fibonacci has levels. We have the 50 levels, 38, and we have the 61. The 50 is the equilibrium, so meaning the half point where the price can reach for you to have optimal trend. But also the 61 is also good, because this is what we call the deep retest. And with Fibonacci coinciding with maybe a fair value gap or an order block area, that is a high probability trade. Then you know that your stop loss will be here below this row, and your target will be up there, targeting the recent high that was created. So that also applies in the case of a downtrend. So the last row that was broken, the high that broke the low, you draw your Fibonacci tool there. We'll look for the 50, 38, and 61 levels, and look for areas in which that they can give you a setup, and also look for an order block, a fair value gap, and other use indicators like RSI, MACD, either any which you use. If at all you use those, the one that you are comfortable with are the one that you can use. But for most of us, especially me, I do use necessarily the Fibonacci tool, because it's more accurate and it's immediate, so it does not lag. Because the price went up to those area, you already know that price is going to a direction, and what you need to see is a confirmation. So guys, that is how you look for alignment. So we have said before you set your stop loss, you have to know your risk tolerance, also the market structure that you are trading, and also the strategies that you are going to use. Let them have an alignment. So we have said alignment is when there is one or more than one strategy that you use, or indication that gives you the same results if you use it. So combine, there are those people who use the trend line. We also have those one who do the parallel structures like that, the channel. So when the market touches the first time, the second time, okay, the third time you anticipate there is a buy, and then you take a buy position. So your stop loss will be below this low or below this channel. So that is also a way that you can use. The next thing we are discussing is what to avoid when setting stop losses. So we have looked on what you should look before setting your stop loss, and now we are looking on what you should avoid. The first thing you should avoid, guys, is to have a fixed stop loss for all trades you take. assuming you say that in maybe in one pair I'll be risking $10. So I'm using this as a simple way of elaborating this. If you are risking $10 to maybe trade Euro USD, you should not have the same fixed mind that you are going to risk the same $10 in a pair like gold or maybe Saudi XAUD, because there is so many factors that contribute in every pair. If you can look on Euro USD, the spread is small or tight spread, but on gold we have a wide spread. So meaning your $10 risk can be easily wiped out on gold pairs compared to how you could have maintained a good stop loss with the $10 on Euro USD. So also here comes the matter that stop loss is subjective. When trading higher volumes setups or higher volumes pairs or assets, you should look on other factors like the pip range maybe per day for each and every pair currency, so that you can determine how far can it go for my setup to be invalidated in case I'm trading this pair. So never have a fixed mind that I will be only risking $5, $10, $100 in one pay in all the pairs. It has to be subjective. Then the next thing is big stop loss than your target. This is very, very, very common in amateur traders, especially those who are starting this journey, because you get yourself most of the time that you have seen a setup and there is a break of structure, but instead of waiting for a confirmation, you get that when prices now start to pull back to here, you put a buy position targeting maybe this high. Remember, we put our stop loss depending on the market structure, so stop loss should be below this low. So if you check this distance from here to here to here, this distance is very short compared to this one. So whatever you are risking at $100 to just get $30. If you do this and you lose 2 times, you have wiped out a $200 account, and if you win twice, you have won $60. So if you check the difference, you'll have lost $140 trying to get to $30 with an $100 account dollar risk. So also make sure that your stop loss is giving you a risk to reward ratio of about 1:2 or 1:3 RR in every trade you are taking. Let it be the minimum. So watch out on this. I emphasize again, never press a bigger stop loss than your target. So always use those setups to confirm that your stop loss is it's in a favorable position, that if it is violated, there is a probability that your setup was invalidated and price might change direction from the one you are expecting it to. The next thing we are going to discuss is about changing stop loss. So another thing that is troubling beginners especially is by changing your stop loss. By changing your stop loss means if you had a market trending and you have put your stop loss below this row and you are targeting to take a trade from this area and here, and then you see that the market is going against you, you keep on changing your stop loss. In the end, you'll get that if you had risked $10, you will end up having a loss of almost a loss of almost 20, 30, $40 loss in every trade you are going to take. So be attentive, be exact, follow rules, set up your rules, and then never change your stop loss. If the market aims at hitting your stop loss, know that your setup was invalidated and you need to look for another structure for you to trade. So that is how you should these are the things you should avoid when setting your stop loss. Another thing is what you should do when setting stop losses. This means that you need to be flexible first. To be flexible means that you should not have a fixed stop loss in every trade. In every trade you take, look for the structures, and if the structure is telling you to put a stop loss on a certain position, don't say that because I'm risking 15 pips only, or maybe 10 pips only per my trade. If the stop loss is telling you to put a 20 pip stop loss, use that one. Next time you'll get that the stop loss is advising you to put a 30 pips stop loss, use that one. But remember, the most important thing is risk management, where we are checking on the risk to reward ratio on our returns. If I was to risk 30 pips, I know that my setup is capable of giving me 90 pips, so 75 to 90 pips. So this will give me an RR of 3:1. So that is how you should do about being flexible. Then base your stop loss based on the structure and alignment. What are we saying about this? When the market is creating higher highs and higher lows, base your stop loss on the basis of the market structure, the low that is created, or maybe if there is an order block somewhere there and you have confirmed price has reversed from that position, you can put your stop loss below the order block after there is a good confirmation. Then we have said that alignment, if your structure is on a higher time frame and you are anticipating a pullback, after the market has pulled back, go to your confirmation time frames or entry time frames to check for the alignment there. So don't get into trade without confirmation. So that is what we are talking about, structure and alignment. The next thing is you should determine by the pair you are trading. So stop loss should also be determined by the currency pair you are trading or the asset. This means that if you are trading gold, we have said that gold is higher, it has a more pip range per candle range compared to others. So you would find that a 1 minute candle of gold can wipe you $2. Maybe it has a 20 pip range or maybe 10 pip range and above. If you compared it to like Euro USD, you'll get that a 1 minute candle has allowed 0.5 to 1 or 2 pip on a normal circumstance. So you should know that if I'm targeting a structure with gold, I'll only look on the structure itself and then measure the pip ranges, and then I'll have a conclusion where should I put my stop loss, and this one will be subjective. Also likewise, if you are trading on Euro USD or maybe other currency, I'm using this as an example, you know that if I'm targeting 5 pips stop loss, that is favorable because the movement of price or pip ranges is smaller compared to other currency pairs. So this one also should be subjective. So guys, thank you for watching, and don't forget to subscribe to this channel and to share and like, so that we can reach more audience and have more setup like this in the coming videos. Bye bye.